7 days ago, Danny, yourself and myself sat around the desk and we discussed bear steepening. Here we are 7 days later with a very, very important piece of evidence to promote duration. How does that play into your view on the curve now, 7 days later?
So, you would say, what does one data point do? Well, it gives the Fed confidence. It gives the market confidence. On the steepener, so I've had a lot of conviction on the steepener, whether it was bear steepener or bull steepener. I think now I have more conviction on duration itself. And here's why. As the Fed starts to cut rates, and we think we're there in September, whether it's September or November, the Fed's almost there. The curve can continue to steepen. But I would look at duration because in a soft landing scenario, the Fed cuts to, let's say, about 3%. In a hard landing, they're cutting much more. But, that's where what's priced in, 3.5 end point. I think we move away from when do they start to the totality of cuts. And in a soft landing, I would argue there's still more room for rates to fall in that belly of the curve, that 3 to 7 year sector. We do think those rates can fall in a soft landing. And here's where that hedging property we were just talking about, you get any weak data, the market's going to price in more cuts. We should price in the scenario that maybe it's a 20% chance. 20% chance that the Fed can cut much below that 3.5 is why that duration now starts to look attractive. Look at all-in yields. If you're getting 6%, in high quality spread product, you're supposed to buy it now because in the next 6 months, that opportunity is going to go away because just treasury rates are going to start to fall as we sort of embark on the easing cycle.
I really like that idea that this market's going to concentrate not on when we cut, but how much we cut. Because that is a debate. There's a difference between a mid-cycle tweak and a full cutting cycle. So what difference does that mean for you in your duration allocation? You say it's attractive either way, but how much can you fully go in if it is a mid-cycle tweak versus more aggressive cuts?
Right, great point. Soft landing rate cuts are rare. They're rare, they're hard for the market to get its head around because we haven't seen it. Now, we're in a soft landing right now. I think the question is, do we continue? To your point, I think conviction on duration has to be a little less. So are we putting our entire risk on? No. Given the data right now, we might persist, we might stay in the soft landing. In that scenario, the Fed cuts to, let's say, 3%. So then how much can that 10-year fall? The 10-year then should probably be between 3.5% and 4%. We're not that far from that. So I would put less, I would put some risk on here in duration, just not max risk. If you start to see signs that the cracks that we've seen cracks in low-income consumers, small businesses, if they start to broaden out, if we start to see those job numbers, and again, I would say we don't look for negative payrolls. I think anything around 100, 150 is telling you that the unemployment rate's going to rise, well, then you add a lot more duration. So mid-cycle correction would be, I would say, 200 basis points of cuts. Recession, we're talking a lot more. That's when I think that duration, the amount of risk you can put on duration starts to increase.